We're analyzing Block, formerly Square, stock ticker SQ, to see if it's a great business on sale. We're using the Select 6 analysis to look at the most telling financial metrics before estimating a fair value for Block. Then we're giving a final rating to the business. This analysis is just over 10 minutes. It's going to be intense, but it's going to be worth it. Before we get into these valuable metrics, let's understand Block stock performance. Right now, Block trades for $61.75 per share. Year to date, their stock price is down 3%. In the last 5 years, Block stock price is up 5% overall. They're compounding at 1% annually. Block is down more than 75% from their all-time highs in February of 2021. Going back 7.5 years ago to when Block was publicly listed, the company's stock price is performing very well. They're compounding at 25% annually, even after their big declines. Their stock price is up nearly 5 times in the last 7.5 years. Block trades $30 below their 52-week high. They're trading $10 above their 52-week low. 4% of their shares are sold short. Block is a big business. They have a $38 billion market cap. But the burning question is, why should we be paying close attention to Block? Founded in 2009, Block provides payment services to merchants along with related services. The company also launched Cash App, a person-to-person payment network. In 2022, Block's payment volume was a little over $200 million. Now that we understand the business, let's get into the numbers. Starting with metric number 1, we want their average return on capital in the last 5 years to be above 14%. The typical business earns about 7% returns on capital. Looking for a benchmark that's double this could build in margin of safety based off the quality of the business. Block's returns on capital have swung from being positive to negative back and forth a couple of times in the last 5 years. Averaged out, Block has negative returns on capital, meaning this is an X on metric number 1. Block has yet to see sustainable returns from their investment into their business. Metric number 2, we're looking for growth in their revenues, net incomes, and free cash flows. All three have to be up for this to be a check. Block shines here. Block's revenues have grown 5.5 times. Their earnings, which were negative in 2018, have bounced around in a couple of these years. They're even more negative today. Block has had positive free cash flow in all 5 years, but their free cash flows are down from where they were at in 2018. Because their net incomes and free cash flows are down, this is an X on metric number 2. Metric number 3, we're looking at Block from the view of an individual shareholder. We want to see earnings per share growth in the last 5 years. We just learned their earnings are down over this time. Block's also diluted shareholders by 46%. They've had pretty stable dilution in all of these years, both for some acquisitions and share-based compensation. This is a 1-2 punch that's lowered their earnings per share, meaning this is an X on metric number 3. Metric number 4 is a similar story. We're looking for free cash flow per share growth in the last 5 years. Block's free cash flows are down, and with their shareholder dilution, this is another X on metric number 4. Block's not that hot through our first 4 metrics. We're 0 for 4, still trying to find our first check. During recessions, it's overly levered businesses that are at the greatest risk of poor outcomes. We want Block's net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow they produced in the last 5 years. To be below the sum of the free cash flow they produced in the last 5 years. Block ended their last fiscal year with $724 million in net debt. Since then, Block has both reduced their debt and increased their cash position. Right now, Block actually is sitting on a cash cushion of $430 million. They have negative net debt. In the last 5 years, when we add up Block's free cash flow, they produced $1.25 billion. With Block generating cash flows and having this cash cushion on their balance sheet, this is our first check of the day on metric number 5. Let's see if Block can build on the momentum as we get into our valuation methods. The big metric of them all, metric number 6, we want Block's average 5-year free cash flows divided by their enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury, Warren Buffett's preferred benchmark. It's the first of 2 different ways we're estimating a fair value for Block. Right now, Block has a $38 billion enterprise value. This accounts for both their market cap and their net debt position. It's a view of Block similar to it being a private company. We learned in our last metric, Block has produced $1.25 billion of free cash flow in the last 5 years, meaning they produce an average of about $250 million of free cash flow. When that's divided by their $38 billion enterprise value, we get a small 0.66% average free cash flow to enterprise value yield. Block's only produced $79 million of free cash flow in their last 12 months. When that's divided by their $38 billion enterprise value, we only get a 0.2% current free cash flow to enterprise value yield. Both of those are well below the yield of the 10-year treasury, meaning they're down from the risk premium as well. This is an X on metric number 6, but don't just throw Block out. We need to estimate their fair value per share. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Block, which takes us on to using a discounted cash flow model to estimate Block's fair value per share. A DCF model is based off the predictability of a company's free cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. We're starting with an average of Block's last 3 fiscal years worth of free cash flow, then using assumptions to grow these into the future. It's up to you to figure out if these will be accurate or not for Block. Assuming they grow their average 3-year free cash flows at a rate of 24% annually for the next decade, then in the following decade, assuming this growth rate is cut in half and these cash flows grow at 12%, if we add in their tangible book value, which gives an estimate of their net worth, if we're seeking a 15% rate of return, which is what Warren Buffett's looking for from his investments, from today's valuations, an estimate of Block's fair value per share is around $18. That's less than a third of their current stock price, down more than 66%. There are key factors to keep in mind. Block has not been that predictable in its past, due in part to its high growth, so that impacts our assumptions. Their cash flows have also been lumpy. These growth rates could be pretty generous for the business. Most importantly, this analysis isn't financial advice. It's not a buy or sell recommendation of any security. Consult with your financial advisor before making any investment decision. In just a minute, we'll talk about our final rating for Block, but we have to address something first. We've covered the numbers, but the qualitative factors of the business may be even more important. What are they? Looking at the factors supporting a long thesis, number 1, electronic payment growth is shifting overseas, and Block's business model looks portable in international markets, as the company does not rely on a large local sales force to attract merchants. Number 2, ancillary services are becoming a more critical engine for growth and will help Block fully monetize its merchant client base and improve margins. Number 3, the ongoing shift toward electronic payments has created and could continue to create room for payment companies to see solid growth without stealing market share from each other. We want to provide a balanced perspective. Let's look at the negative points as well. Number 1, Block's relatively high pricing will likely put a ceiling on its eventual market penetration. Number 2, Block has not yet shown that it can convert its strong growth into better profitability. Number 3, Block's focus on micro and small merchants increases its economic sensitivity. There you have it for a balanced perspective of some of the qualitative factors of the business. Now it's time to give our rating. In analyzing Block, formerly known as Square, stock ticker SQ, we learned the business has grown their revenues rapidly in the last 5 years. They also have a cash position on their balance sheet. They've generated positive cash flows in each of the last 5 years. But their earnings have been negative, their free cash flows have declined over this time, they've diluted shareholders by 46%, and they earn low returns on capital. It's worth reiterating this analysis is not financial advice. Right now, based on Block's free cash flow to enterprise value yields, it doesn't look attractive compared to the yield of the 10-year treasury. When we performed our discounted cash flow analysis, from today's valuations, if you believe the assumptions and want that 15% rate of return, an estimate of Block's fair value is around $18 per share. You'd have to go back to April of 2017, the last time Block traded at those levels. Looking at all the factors of our analysis, Block looks like a weak candidate for further research. Don't let that discourage you if you're interested in the business. Again, this is not a buy or sell recommendation of any security. Consult with your financial advisor before making any investment decision. If you enjoyed today's video, be sure to like the video, subscribe to the channel for more stock analysis videos, share your thoughts about Block, and let me know what business to look at next in the comments below. Thanks for learning about Block with me, and have a great day.